Hi everyone. I guess slowly I'll have people joining me live on Instagram. I hope you had a great and productive day. I had a very busy and a very productive day myself. So I'm hoping that all of you had a very busy and productive day. It's nice to have a Monday morning like that when you start the week on the right tone, as they say. When you get bat and ball, and it's a great feeling when you're able to get yourself in the groove, the first over itself. So that's how it felt. This Monday was a very good Monday for me. So I hope all of you had that kind of a Monday. I did manage to catch the market as it was closing, and I did manage to invest in some gold bees myself. So I was rather happy about that because the market seems to be running on an A train, as they say. It seems to be going off the rails in one direction. And till some sensibility comes back, we have to be patient as value investors and take the opportunities as and when we're coming. And talking about that, I wanted to lay out my thought process for this month of June. I did not get my thoughts out for the month of June as many things was going on, and Anand had me traveling up and down to Chennai and back to Bangalore, and I could not get into talking about what I think month of June may look out for us as our Tiffin Coffee range investors and where we should be keeping our eyes on. This month will be a month of divergence because the market, globally speaking, across the US, Japan, India, there seems to be a global equity rally going on. I've spoken about this in the videos, and why and how it's happening. It seems to be purely driven by liquidity. This rally which we're seeing is not an earnings rally, it is a liquidity rally. That means a lot of cash is floating in the market, and that cash is pushing up equity prices because there's a lot of exuberance and excitement in the market. Understandably so, because there are very few asset classes where investors can go sit right now. Because the warning signs I'm saying this is, it's not an earnings trade, is the visibility of the 10-year bond yield in the US, that going up is not a good sign. Because more and more it is showing that it is a liquidity fuel divergence and not an earnings based divergence. And the global liquidity flush is what is pushing all this towards where we are. And when will this rally end? That's very hard to say, because even our RBI seems to be joining in the fun when cutting and creating more liquidity in our market. Especially in India, the liquidity seems more and more on the surplus side, and asset prices may stay high for now. And market sentiment is driven by purely on sentiment. The market, it is not driven by fundamentals. And we as value investors must remember this. We should always focus on fundamentals and not on market sentiments, because the bond market is a true warning. If the US 10-year yield is sitting close to 4.5, that shows this is not good. And history has always told us when yields go up like this, PE compression soon follows. PE compression means PE gets compressed. The price to earnings ratio starts becoming smaller. So that means markets should correct. And when it does correct, what will take the biggest beating first would be the tech stocks and the growth, so-called growth stocks. Those are the ones which would probably take the hit first when we look at a market correction. FIIs are returning to India, and they are returning to India especially to financials. NBFCs, banks are seeing a lot of volume from FIIs, but there's a tremendous pressure on net margin, interest margin in India. What is NIM? NIM is interest earned, which is what banks earn from loans, minus interest paid, which is the deposits. So that difference is known as net interest margin. That's the profitability for financial banks and NBFCs. There is pressure on that. So keep an eye on liquidity there too. If there is any warnings which we see in NBFCs and in banks, it will be a liquidity crunch there too. Consumption trends, if you look at it carefully, urban consumption is improving, but rural is weak. Especially FMCG companies which have heavy rural exposure are finding it harder to show growth. So growth is sluggish. Raw material costs are going up, input costs are going up, so there will be a margin bite for FMCG too. Pharma and healthcare, if you look at it, it's a good place for us to hide, and that is where we've been hiding for quite a long time. Us Tiffin Coffee Range investors, we've been sitting in the pharma healthcare stocks. Though the US exposure companies did take a bit of beating, they're showing signs of recovery, and domestic demand is good for pharma also. Case in point, even today, Eli Lilly's Indian Mojaro weight loss drug seemed to be doing better than Ozempic. All that is good news for the pharma sector. And in pharma sector, I would say be careful. Don't do sectoral. Look at more stock picking. Pick companies in the pharma sector this month carefully based on earnings and price. In terms of IT and tech, we've always said they're in a crossroads. Things are not great for them in terms of delays in deals. Deals are not getting finalized. Margins are not great, but iteration has gotten better. But the US recession cloud still hangs over their head, which has been a big problem for them. And the AI uncertainty still lingers on. We do not know if it's a blessing or it's a curse. Of course, there's lots of snake oil there, which I've been talking about, especially after reading that book, which is a brilliant book. And I highly recommend all of you read that book. It'll give you a great perspective on this whole AI nonsense. So, especially with all that put together, tech sector is something I would definitely not look at too keenly this month. I will avoid companies heavily in debt, and those companies are in industrials and infra. Government is not looking at spending in anything great in terms of capex other than railways and defense probably. So if they are heavily leveraged, it is best to stay far away from them. In terms of what you should do now for the month of June, I would say try and focus on defensive stocks. That will be healthcare and FMCG, looking at earnings and looking at margins. And whenever you do find value gaps, right, look at those companies. For heaven's sake, please avoid PSUs. Whatever is so-called PSUs we have are all heavily stretched in valuations. So stay in the private sector and keep your eyes on their earnings to price and see if you find value there. Keep doing a Tiffin Coffee Range investing. There is no necessity to get out of Tiffin Coffee Range and go anywhere else, or if you want to call it sipping. In June, the places where I'm going to keep my eye on is pharma. I'm going to keep my eye on banks, gold, of course, and if there's anything in specialty chemicals, I might look at it. I would avoid anything in AI and EV related right now. That said, I would not jump into any momentum trades or momentum stocks. So as you guys say, I would look for sustainable margins myself. I'm trying to protect my capital. I'm trying to stay rational. And that is what my advice would be for you for the month of June. In terms of news, what I saw which was of interest was China has been squeezing us on rare earth materials, especially the magnets. So I recently read about this Midwest, which is planning to do 1,000 crore investment in Sri Lankan mines looking for rare earth. They seem to be doing an IPO also, I think. I would not do their IPO, but it is of interest, the news. Trying to see how Indian companies are moving around trying to get through this. And Berger Paints had a outperformance in Q4. That means there's more pain for Asian paints and there's more pressure on Asian paints. Am I looking at any of them? No, I'm not looking at any of them right now. And it was interesting to see Rapido's growth, which has been great. That means there's more pressure on all the other so-called gig economy workers and the gig economy companies, even ones which are doing food delivery like Swiggy and Zomato, because the work pool which they all dip into the gig workers from are all constantly the same. So Rapido's expansion is great news, but it's going to add further margin pressures to all the other gig working companies. This is basically what I'm seeing for the month of June. Now, in terms of bond investment, a lot of you have been asking me, can we consider some passive bond mutual funds in India? Because we are not able to pay 1 lakh and buy bonds. And if that is the case, I would say I would rather that you invest in Nifty 50 passively and slowly accumulate to that 1 lakh and reach that 1 lakh and then look at bond. That is what I myself am doing. Whenever I'm not able to buy a bond, I keep accumulating passively in a Nifty 50. And when I reach the threshold of buying a bond, I liquidate my positions in Nifty 50 and I take it and I buy a bond. So that is my strategy. I have nothing against these bond mutual passive funds. Passive funds are the best. And I've said this many times, even I agree. Passive funds are great because their ratios are lowest. And in the long term, like Warren Buffett's famous bet, they will perform well. But in the case of bonds, I would rather enjoy the bond myself and enjoy the interest myself, and I would like to hold the bond to full maturity. That would be my strategy. So that would be my advice to you too. If you would like to do that, you're welcome to do that. If you like to try and investigate these other bond passive funds, do investigate, do your due diligence, have a financial advisor, like I always said. Ask your questions, ask your doubts, read the literature from cover to cover, every single word. If you don't understand it, ask questions on things you don't understand. But for heaven's sake, do not rush into any form of investment. This I cannot stress more than anything else. Do not have FOMO. You have not missed anything. If you have just awoken to this whole idea of investing and creating wealth, take your time. There is no rush. Like if you have anything in life you want to achieve, be it weight loss, be it, kicking a habit. Suddenly, if you try to do it, it can disrupt your whole mental frame of mind and your health. So have a plan in place so you can be successful in this. The important thing is having a plan and taking time in creating a plan and then implementing the plan. If you are interested in anything related to all what I spoke, I'm available on Instagram. You can reach out to me. I will try and answer your questions and interact with you in the different copy range group which we have created. I do my best to answer your questions. But when it gets to talking one-on-one, you will have to be patient because there's many of you who are reaching out to me, asking me for a one-on-one conversation, and I am getting through that list one by one. So if you have the patience, please wait and I will get it through to you eventually. I understand the frustration that I'm not getting through to you as soon as you would like, but I will get there soon. Nothing else more to say. I hope you had a productive day, like I was saying in the onset of the video. I hope you had a wonderful day. Tomorrow I'll be back here again and I will try and cover what's been happening in the news, which I found interesting, and probably have a few questions that you have managed to ask me. I'll try and answer. I'll put up a question post on Instagram today so you can populate your questions, and that will give me 24 hours to collect all your questions. And tomorrow same time I'll try and answer some of your questions and give you my views on what's happening in the market and probably what I did with my own little capital Tiffin coffee for the day. Nothing else more to say. I hope you do have a wonderful day again. See you soon tomorrow. Good evening.